Gold is making a grand comeback. This year, India's spot prices hit around 1.09 lakh rupees for 10 grams, thanks to a global surge and a weaker dollar. And this is not a one-off thing. Gold was India's top performing major asset last year in 2024, gaining about 21% in rupee terms, and this year, it's only pulled further ahead. By June 2025, the World Gold Council reported a whopping 26% gain in just the first half, compared to a modest 6.3% gain year to date from the Nifty 50. So, what's getting gold all buzzing? Today, our agenda is simple. We're going to get the full lowdown on gold. Who's buying? Who's stepping back? And what are the risks here? We'll also talk about how wild can the price swings get, and get to the part that almost everyone wants to know more about. What should investors do next? Stick around, because as we usually tend to do here at Bottom Line, we are diving India first and data first, and finishing that up with a practical game plan that you can actually use. Welcome to Bottom Line by Groww. Let's dive deep into the gold story. Now, there are a lot of moving parts and there's a lot of stuff happening out here, so let's break it down one piece at a time. So first up, let's talk about geopolitics and the policy risk premium. You see, when uncertainty spikes, and when I say uncertainty, it's stuff like wars, trade tensions, or generally doubts around the policy trustworthiness, investors pay a risk premium to stay safe. And that risk premium usually means buying gold as a hedge. And lately, global conflicts and even debates around the Fed's independence have nudged portfolios to add gold insurance. It's really the classic safe bet in a multi-asset portfolio. That's the first part, geopolitics and policy risk. Next up, we've got real yields in the US dollar, the classic macro duo. Now here's the deal on real yields. They're just bond returns after you take away inflation. Simple enough? Alright, let's break it down even further. You see, you have nominal yields, which are the official interest rate on bonds, but inflation starts eating into them. So the real yields are what you actually earn at the end of the day. For gold, this is gold, pun intended. You see, since gold doesn't pay any interest, juicy real yields make bonds more attractive. But when real yields fall or even go negative, gold suddenly starts looking pretty good. And the other player here, the US dollar. Now gold's priced in dollars, so a strong dollar makes gold expensive all over, while a weak dollar makes things more affordable, and then the demand just jumps up. Right now, the markets are hoping for an easier US policy, a rate cut bonanza and a softer dollar. It's the perfect recipe for gold to shine. So rate cuts plus weak dollar equals, it's a gold boom. So not really a big shock. Gold's mid-September highs came in right as rate cut hopes jumped up and the dollar softened. So far, we've covered two things. We have spoken about geopolitics and the policy risk, and the US dollar and the yield. Amidst this, let's talk about a very underrated hero, the central bank. Now, they've been net gold buyers for 15 years straight up. And since 2022, that buying has jumped well above the usual 600 tons per year. And China has been on a full-on shopping spree as well for 9 months straight, even into July. And that's because gold diversifies reserves away from over-reliance on US assets. It hedges against sanctions and settlement risks, and it holds value without being anyone else's liability. And gold also has zero default risk, zero counterparty risk, and it stays liquid through thick and thin, BFF. It's the perfect balance for central bank portfolios that are loaded with US treasuries. And Hamara RBI, they are steadily adding gold in this year in 2025. Not mad wildly, but consistently. Unlike our exercise routines. Central banks just love gold. And India's gold share of total forex reserves has also jumped up from about 8.9% in July last year in 2024 to roughly about 12.1% in July this year. And that's a structural shift in how they're mixing portfolios. Now, over 5 years, the gold portion's value in India's reserves has soared to over 80%. And this has grown faster than other reserve parts. So all this is solid GAN, but why does this matter? Because a steady central bank buying softens gold's downside. Now let's keep it real and track what really moves gold's price. US real yields and the dollar index. You see, when real yields drop, gold shines because it doesn't earn interest but doesn't lose value to inflation either. If the dollar weakens too, gold gets cheaper for the rest of the world, boosting demand. Now you put these two together, falling real yields and a soft dollar, and you've got gold on a smooth upward path. You zoom out, gold in rupees is like India's financial shock absorber. Every 10-year chunk, it's never lost money in INR terms, always showing positive returns. Returns typically sit between 8 and 10% every year. And the reason is simple. India imports almost all its gold. So when the rupee weakens against the dollar, the local gold price goes up, even if the global prices stay steady or they dip. This currency cushion means INR gold doesn't crash as hard during global slumps and rebounds faster when things turn around. Indian investors get a smoother ride. So yeah, gold cushions the rupee shock. But heads up, over shorter terms, gold can be a roller coaster. You see, you take a 12-year stretch, we've seen losses sometimes hit a steep 37%. I mean, these dips are rare, but they kind of remind us that gold isn't a volatility-free zone as well. But you stretch that horizon to 3 to 5 years, that view gets very friendly. Now, returns usually tend to bounce back to about 9% CAGR over the last 54 years, showing gold in rupees is a reliable long-term store of values. And, well, even our ancestors will agree to that. So, short-term, bumpy. But long-term, it's a steady reward. That's the rhythm that all of us should remember when you're deciding how much gold you want to pick up and keep as well. But here's something interesting. When gold hits record highs, the winners and losers in India flip. Now, investments are stealing the spotlight, jumping from 21% a few years ago to almost 44% today. Now, that's driven by investors chasing rate cut hopes and safety through ETFs, bars, and coins. Meanwhile, jewelry is also losing ground, from 49% of the market to about a third. Now, high prices are also squeezing out the regular buyers, leaving private investors in charge of the quarterly gold dance. For lenders though, this is golden time. Gold loan NBFCs are on a full party mode. Every price spike pumps up collateral value and it grows assets under management and fat profits. And the folks at Muthoot nearly doubled profits in Q1 FY26. Also adding fuel to this are Reserve Bank's tweaks on loan-to-value rules for small loans. When prices hit records, financiers can lend more against the same gold. It's a full-on win-win situation. But jewelers, they're walking a pricing tightrope. Big brands like Titan have reported over 50% profit growth recently, but they're also saying that Janta is buying lighter and simpler designs, and at these levels, price sensitivity kicks in really hard. Mass market jewelry demand is clearly feeling the squeeze. Last quarter, India's jewelry volumes dipped around 17% year on year, as that 10,000 rupees per gram price point stopped many people and they just didn't make the buy. So when gold surges, here's what happens. Lenders switch on party mode, premium brands start shifting gears, mass customers start pulling back. So you have one rally and you have different winners and losers depending on what your gold game is. Now, talking about a new car or gold leads to only two standard questions in India. How much mileage, or will gold prices go up? So let's get to that most important part. Is gold likely to keep rising? The base case is yes. Now the conditions are looking clear. If the Fed keeps easing or signals ease, the dollar stays soft, central banks keep buying, and ETF inflows stay positive, gold has a push to move up. We are seeing those signs now. We've got fresh highs, rate cut optimism, and steady support from banks and ETFs. But what if things flip? You see, if the dollar bounces back, real yields rise because the Fed gets hawkish and ETF flows reverse or central banks pause buying, then you're looking at a correction risk. But for Indian investors, it's a tad nuanced. On one hand, macro winds are still favoring gold. The rate cut hopes and softer dollar will help it keep its ground. Central bank support and ETF inflows can provide support. But on the other hand, you're also buying at record rupee prices between 1.08 and 1.1 lakh rupees per 10 grams. At prices like this, pullbacks tend to happen when the Fed surprises or dollar stiffens. So what should be your POA? Plan of action. Now, if you're in it for a hedge or long-term diversification, just stagger your buys. And there it is, the full gold picture. All the movers, all the risks, and what it means for us investors. Do you agree? Are you thinking differently? Share your thoughts in the comments below. And thank you for watching Bottom Line by Groww.